We're great at spending money, but we're not great at spending money to get a good outcome, and you can see that with kind of the flip-flopping on the inter-islands ferries, the motorways, the train lines, core infrastructure spending can really give an economy a shot in the arm, and we failed to do that over the last, I would say, 5 to 7 years at least. Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair, and today, our quarterly update.
We're back in your life to talk about the quarterly update. Now, Mike, we're going from the 1st of April to the 30th of June.
So current.
For our listeners out there, we also use this for our Lighthouse investment portfolio clients to give them a investment update. And we thought rather than restricting it to a small audience, we would also make it a podcast episode where we talk about what is happening in the markets and performance of asset classes, which you can also apply to your Kiwi saver to a certain extent.
Mm-hmm.
Now, Mike, this is to the 30th of June.
Yeah.
But some things have happened since the 30th of June.
Nah, it's been pretty smooth sailing. Markets have been fine. Official cash rate has been fine. I don't see what you're talking about.
So Michael is joking, of course. So over the last couple of weeks, the S&P 500, which is the top 500 companies in the US, dropped 5%. The reason it dropped was for 3 key reasons. One is concerns of unemployment numbers that have just come out in the States. So the unemployment number came out in the States about 4.6%. Actually not that much of a jump, but higher than they thought.
Do you think that there was perhaps a bit of an overreaction and markets being a little bit too sensitive to those numbers? Because it's not, considering where the global economy is at, it's not too surprising.
Markets are kind of like your ex-girlfriend, where you say one thing slightly out of line and they react a lot, right? That you're 100% right. Wasn't that big of a deal. But this huge reaction, you're sleeping on the couch for a week and you're like, what have I even done wrong? So I do tend to agree that it was a big reaction. This then spurred on a concern that the US could potentially go into a recession, which then spurred on markets thinking that the Fed in the US was too slow at cutting rates. And then to wrap it all up, we have AI stocks, which are very overpriced because they actually haven't really delivered anything. And people have just started to wake up to go, oh, maybe I've spent a bit too much money on these stocks.
Tangent, do you think at some point there is an AI stock that is repricing that is making those calculations for hedge funds and is like, oh, I am overpriced?
That's deep. That's like reflecting on ourselves.
Yeah.
I don't know if I have that within me.
I reckon there will be AI repricing itself somewhere.
Yeah. I also think about will AI, how there's humans at the moment that check the AI? I'm like, will there be AI that checks the AI? And how do you know the AI that's checking the AI is the right AI? So what happened in the US? Then our friends in Japan woke up and they freaked out. The Japanese stock market dropped 12% in a day, which was the largest single drop in a day since the 1987 stock crash. Now, do you want me to build you back up, Mike? Because I know this is a little bit concerning.
Yeah.
Okay, since that has happened, the Japanese stock market has jumped back up. The US stock market has recovered. I think it's only down about 3% over the last month. It was very short-term volatility, but if you look at your investment portfolios, you look at your Kiwi savers, there definitely was a period of time where you go, what the hell was going on?
There's a sea of red, yeah.
Yeah. So that's what happened over the last couple of weeks. You want me to talk about what happened over the last quarter?
Go on then.
Okay, so while AI stocks did tank over that quarter from the 1st of April to the 30th of June, AI stocks continue to boom.
Mm-hmm.
That Magnificent Seven continue to do well in the States. International equities, because of those large cap tech stocks up 3.1% over the past quarter. In addition to that, emerging markets had a really good quarter as well, so 3.1% over the last 3 months.
When you say emerging markets, what does that actually mean?
So it's like you think about like our established economies, right?
The US, Great Britain, the Euro.
Yeah, that's right. And then you think about where are the countries around the world that are maybe not as strong. So maybe parts of like Southeast Asia, India, Africa, those sort of countries.
Yep, cool.
Now, when we think about other markets, the NZX 50.
Emerging market?
I tell you what, it feels like it now. So do you want to hear a stat, Mike?
Go on.
NZX 50 hasn't gone anywhere in 3 years. It's flat.
Yeah. And okay, so we're not an emerging market. We're probably a mature market, but we don't seem to be doing much. Why are we underperforming the rest of the world?
It's a good question. So over the last 5 years, it's only increased 13% in
Yeah.
comparison to the S&P 500. That's up 80%. That has gone up more than 4 times as much as New Zealand.
Yeah.
Now, I think there's a few reasons why. The first one, to be fair to the States, they're doing pretty well at the moment. Granted, their country is divided. There are a lot of things they're not doing well. Their GDP numbers are strong, though. So their GDP is at about 3% over the past 12 months. And their per capita GDP, which is a really important number, is still at about 3%. New Zealand's GDP is negative because we're in a recession. And our per capita GDP, because remember, we've got like 140,000 net migrants coming to the country, we're back like over negative 1% or something like that. Now, I'm sure you'll have some thoughts on why as well. If we go, why has this happened? One part was probably we were asleep for a period of time during COVID.
Yeah.
People can argue till the cows come home in terms of whether that was right or wrong, while other economies got on with it. And then obviously we've struggled to kind of move on off the back of high inflation and a high interest rate environment. Although an OCR cut today is certainly welcome news. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. Yeah, it is. Absolutely. I think you're right with the country being asleep. I think fundamentally the fiscal policy in New Zealand for quite some time has just been a bit lacking, and that actually we're great at spending money, but we're not great at spending money to get a good outcome. And you can see that with kind of the flip-flopping on the inter-islands ferries, the motorways, the train lines, core infrastructure spending can really give an economy a shot in the arm, and we failed to do that over the last, I would say, 5 to 7 years at least.
Yeah. And then the other thing, coming back to the NZX as well, is now I definitely think like countries, like companies and markets are cyclical, and New Zealand will go through a period where things are stronger, and like to think it's not too far away. One of the problems with the NZX 50 is, name me the great company that listed in New Zealand. You think about, Xero goes off to Australia, Rocket Lab goes over to the States. Why don't companies want to list in New Zealand?
Yeah, I guess it's the threshold or the barrier to entry to get onto the NZX 50 is pretty it's pretty stringent. And is the juice worth the squeeze, right? If I've got to do 99% of the work to get on the New Zealand Stock Exchange, or I could do 100% of the work to get on the ASX or the NASDAQ, where the amount of capital is so much richer and the flow of capital is so much easier and quicker, it's a no-brainer, right? And I think, to a degree, some of that comes down to our size as a country, the amount of capital we have. We talked to Sam about the amount of money that's now been pulled into or left in the country by the big Kiwi saver funds. But honestly, I think it's just mismanagement from the board as well. The NZX has been underperforming other stock exchanges for some time. And I think, the board really does have to take some accountability for that.
Yeah. So if we NZX 50, big problem for another day. Some good news though, Michael, is bonds. Bonds are back. Bonds are sexy. We've been talking about this for a while. So obviously, if you look at term deposits, they've been high for a while. Bonds have taken a little while to catch up, but across our bond portfolios, they're all probably sitting in around the 8s ranges. Now, just as a reminder, bonds are a debt instrument. They're not like a share where you own the company and you go up and down. A bond is going, hey, I will lend you some money. You pay me some interest and then give me my money back at the end of the period. So bond portfolios are doing really well to kind of propped up portfolio numbers.
So why are bonds performing really well now?
So there was a period of times where bonds didn't perform so well, right? So as interest rates are starting to go up because we're trying to deal with inflation, if your bond is priced at a point in time, that's not very attractive, right? Because you can get 6%, but then you've got like
You're
a
locked in at
2%,
3,
2% bond rate. But as new bonds get issued into the market, because the risk-free rate is going up, not necessarily term deposits, more government bonds, that's when they become more attractive. And term deposits are priced at a point in time, and then start going down as interest rates start to go down.
Yep.
But if you've got a bond that's priced at 8% for 5 or 10 years or whatever it might be, you're getting that return for a decent chunk of time.
Yeah. And for everyone who's still awake, as we descend into the particulars of bonds and bond portfolios, look out for the next chapter.
But I mean, the other thing interesting going forward that will help New Zealand is the OCR.
Yeah.
I've actually got written in my notes, the OCR will be cut at some point. But of course, we found out, Michael, it got cut on Wednesday.
Yeah. So it was cut 0.25, which is great news for the economy, not just because of the short term, drop in interest rates. I think ASB repriced straight after they clicked their button at 201 and, to reprice everything. Now, it's more about what is the direction that the economy is heading. It is the long-term trend that is now starting to change. We have had, contractionary policy for the economy for a long time now, and now we were starting to get policy that will stimulate the economy. I cannot stress how much of a good thing this is for households, businesses, the economy, and New Zealand's standing in the global economy.
And you got to remember, like all the pain that's out there in New Zealand at the moment, unemployment going up, high interest rates, people not spending as much money, it's all been designed by the Reserve Bank. And so we had inflation at 7.2%. We're now sitting at 3.4% or 3.3%. The Reserve Bank dropping the OCR is the sign that going, hey guys, we're getting very close to the end. We're starting to give you a little bit of relief. Yep. And I guarantee you, although some may argue, that what has happened in the States with the stock market would not have hurt things whatsoever with all the concerns around the Fed overcooking rates for too long. Yeah. Because it is a very, and I don't want to be an Adrian Orr spot at all. It is a fine art going, you do not want to put the New Zealand economy into too much pain, but if you pull off too early and inflation starts to go back up.
And all of this was for nothing.
Yeah. That would not be much fun. So in terms of performance numbers on portfolios, I'm just going to quickly run through those. So for our clients listening to this podcast episode, we will send you your quarterly reports as this goes out. And of course, if you have any questions at all, just reach out to your advisor and you'll be having a financial review soon, no doubt. Defensive portfolios.
Yep.
So over the past quarter, they're up 0.5%. And over the past 12 months, they're up 7.2%. So if you compare that to term deposits, we're pretty happy with where those are sitting.
Yeah.
Balanced portfolio, 0.5%, 12-month number, 8.9%. And then if I was just to jump to a pure growth portfolio, which is nearly 100% in shares and property, none of those defensive assets, 0.7% over the quarter, 11.7% over the year. What that means is it was a pretty bloody boring quarter. It wasn't anything particularly, didn't knock our socks off. The 12-month numbers are definitely getting held up by the last quarter of 2023 was particularly strong.
Yeah. And how is those portfolio performance running against the benchmark?
Yeah, we're really happy. So once again, we're independent in terms of the funds that we pick. We're backed by independent research. So it's a pretty simple offering, is going that if something is not performing or something better comes into the market, or there is a lower cost option or a more tax efficient option, then why wouldn't we make a change? And we're constantly tweaking the portfolios.
Yeah, awesome.
Nice. Okay, so any questions at all, feel free to reach out. Just remember, a reminder to all of those out there who have investments that have seen the recent volatility. It's all short-term noise. Yes, we will go into another recession at some point. Yes, something bad will happen. But if you think about what happens over a week, a month, a year, you are just going to stress yourself out, plan for the long term. Do not plan for the short term. Much love to Partners Life for sponsoring this episode. Make sure to subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Consider your quarter updated.